Hi guys, do you know how interest rates impact you as a Chevron employee? My name is Stephen Chambers and I'm a wealth manager here at Willis Johnson and Associates. And today I'm going to be talking about how segment rates can inversely impact your Chevron lump sum pension amount. If you started working at Chevron prior to 2009, your pension is inversely related to interest rates. If interest rates go up, your lump sum pension amount goes down. If interest rates go down, your lump sum pension amount goes up. And in a minute, we'll look at how to quantify that impact to your very own pension. But who this really matters to is if you are kind of on the brink of retirement, say 6 to 18 months, you are thinking about taking a lump sum. Generally, right now in this interest rate environment, we're recommending to go ahead and retire, but defer taking your pension. And we'll look into that in a second. So let's kind of dive into some of the details on where interest rates have been and where they are and where they potentially could go. So kind of looking at this chart, this is the current interest rate situation. If you look back in 2001, where interest rates were high, we had a recession, they dropped fast. Remember the tech bubble, etc. 2008, interest rates were high. We had a recession, a bad recession. Interest rates dropped fast. Can you fast forward to this year? Interest rates have been high. They've been kind of plateaued. The question on everybody's mind is, when will they come down? Will we get a recession? And if historical data is any indication on what could happen to future interest rates, we know that if something happens to like a recession, rates will come down and they'll come down fast. Okay, so the question is, what's going to happen to interest rates? Well, all eyes are on inflation. If inflation starts to come down, the Fed has said they would start to lower rates. Unfortunately, however, if you look at this year's data, the month-over-month inflation numbers here on the right, annualize these numbers, and you're looking at 4 to 5% inflation on a year-over-year basis, which is above the 2% target the Fed is trying to achieve. So, unfortunately, it doesn't look like rates are going to come down anytime soon, right? But things could change quickly. So as a Chevron employee, how can you quantify the impact rates, good or bad, have on your portfolio? Log into Benefit Connect, run a pension scenario, and then at the bottom left, you can click on run additional scenarios. And what you can do is actually stack different scenarios side by side and manipulate some of the variables. So this is an actual client situation where we ran a scenario of retiring at 57, right? Annual pay increase of 3%. And we kept future segment rates flat. And then we compared that to scenario 3, all else equal. The only adjustment we made was we lowered rates by 3%. We calculated the pension scenarios here at the bottom, and the results showed if interest rates stay the same and they elect to take the lump sum, they're looking at about 1.5 million value. If interest rates drop by 3%, their value increases to 2.1, $600,000. In other words, is the impact to this person's lump sum if rates came down by 3%. So again, key takeaway is rates are high, they could drop, and when they drop generally fast. That would have a very positive impact on your pension. So if you're thinking about retiring in the next 6 to 12, 18 months, what about deferring taking the pension because rates could come down, rates down, lump sum up. If you enjoyed this content, please follow us on social media. Thanks for tuning in.